Alright, so I recently posted a video on how to buy a call option in Fidelity, and I got this response from Soggy Cranberries, which is, can you make a video on how to sell an option on Fidelity? Which tells me that I didn't explain that very well in the first video. So in this video, we are going to go through with selling an option in Fidelity under two circumstances. The first being, you already are holding an option. So let's say you followed that first video's instructions properly, and now you have a call option in your account. What are you going to do with that option? You're going to sell it to take profit. I'll show you how to do that first. Second, I will show you how to sell a call option naked, which means that you don't actually have a call option in your account. You just want to sell them to get immediate profits. And I'm going to do both of those because Soggy Cranberries didn't make it exactly clear as to which circumstance he or she is looking to do. And also, he or she asks, how do you determine the break-even price? I'm not really sure what Soggy Cranberries means by that, but I'm assuming it's how to determine whether your call option is going to make money when you buy it. So, I mean, I'll show you a little bit on how to determine that at the end of this video. Let us begin by heading to our Fidelity account and scrolling down to Accounts and Trades and scrolling down to Trade. Click on that and this page will come up. Now we are trading options, so where it says trade stock/ETFs, we want to click and select options. That will pull up a new page that looks like this. Alright, so in this circumstance, this first circumstance, we are looking at the situation in which you already are holding a call option, and you could do this with puts as well. It's exactly equal. The only difference is you're going to be selecting put where it says call/put. In any case, let's say we're going with S. And once you put in that ticker, whatever you're doing, I don't remember what S is. Am I stupid? Oh, Sprint. Okay, so this is Sprint. Shouldn't it be? No, that's really expensive for Sprint. I don't know. I thought Sprint was trading at penny stocks level. Let's just go with Microsoft. Alright, so we are going to sell our Microsoft calls or puts, whatever. Strategy here is still calls and puts. Now here's the key point to selling and taking profit on your options. You need to, at where it says action, you need to select buy to sell to close. Again, sell to close, not sell to open, not any of these others. Always choose sell to close. If you do not choose sell to close, for example, you select sell to open, what's going to happen is you're going to open a new trade and you're still going to be holding that call or put that you wanted to sell. So avoid that. Always select sell to close. Now, from here, you're just going to put in the information about the call or put you're holding. So if you're holding more than one, you're going to put more than one. If you just have one, you're going to put one. So let's say I want to sell 10 of the calls with this expiration and this strike price, and I have calls. And of course, if you're selling puts, all you have to do is select puts. A lot of people get confused. They think because a put is kind of a short trade on the stock market and a call is a long trade on the stock market, then the action needs to be different, such as buy or sell to open, sell to close. No, it's the same. If you're holding a call, you're selling to close. If you're holding a put, you're also selling to close. You're always selling to close here if you're taking a profit. So put in that info. That's what we got. Once you put that in, this will pop up. Double check to make sure this is what you want to sell. Now check the bid and the ask price. This is the range of prices you are working within to sell your option. And we're going to come back to that in just a second. Let me go through this linearly. We have another choice, which is route. Routes you don't care about generally. A route is the exchange via which you want to sell your option. Just go with auto. Order type is something we care about, however. So we have a lot of order types. I'm not going to go through all of them. What I'm going to do is I'm going to show you market and limit. Market is only good if this bid and ask spread are super tight and you don't care about the difference in price. Usually I'll use a market order if I'm trading something super liquid like the SPY and the bid and ask are mere pennies away from one another. In this case, that's not the case. we see that the difference between the bid and the ask is $4, which equates to about $400 per option. And that's not something you want to miss out on. If you're always using market orders, you are losing money over time. If you're always using limit orders and my strategy for setting limits, you're making money over time. Here's what you want to do. Select the limit order, and we are selling, so we want the price closest to the ask as possible. We want a higher price. So we would love to have this sold at $92.90. But that's going to be impossible because that's the ask price. You can't get the ask price right away, but you can get pretty close to it, I've found. Here's what I usually do. I take 5 pennies for highly liquid stocks and 10 pennies for less liquid stocks off the ask price, and I put in a trade with that price. And once I do that, I wait a little bit to see if the order is filled. If it's not filled, I cancel the order. I go back and I do it again, incrementally moving the price down toward the middle of the bid and the ask. And eventually it gets filled, and I get a better price than I would have had I chosen market. So that's what I encourage you to do. Once you have your limit price in there, time in force, let's just say this is going to be good for the day. Generally, that's what you're looking for. You're trying to sell it in a short amount of time. And your conditions, this conditions, by the way, only pops up if you have more than one that you want to sell. Should go away. It did go away once I put the quantity back to 1. So let's say you have multiple you want to sell. You have this new choice, conditions, none or all or none. In the case of none, you will sell whatever the market is willing to buy. And in the case of all or none, you won't make a sale until you have the ability to sell all 11 at once. In other words, if you really want to make sure this gets filled all at the same time, go with all or none. But in general, you don't need to. You just go with none, and let's say only half of that gets filled. That's fine. That's something you can work with, because all you have to do is cancel the remaining order, come back, move the price down, and what you're going to have is maybe half filled at 92.80 and half filled at 92.75. It's something you can deal with, and you can keep that order out there. Even if half of it gets filled, you can just keep it out there, and maybe the other half will get filled later if you're watching it. In any case, I don't think I ever go with all or none. I go with none, and I just incrementally move that limit price down until everything's filled. And trade type, we're dealing with cash, because we have a option that has cash value, and we're going to sell that for cash. And that's it. So once you've got that entered, hit preview order, and hit submit order, and it's done. That's it. Now we're going to go through this again, real quickly, under the assumption that you are not trying to sell an option that you hold. In other words, you want to sell naked options. So basically what you're doing is you're selling contracts. You're just writing these contracts out of thin air. You're getting money for them. And if a stock moves against you, well, you're going to have to pay out to that contract holder. Often, not often, but on occasion, a lot of money. So a lot of people think that selling naked options is dangerous. It's actually quite profitable if you know how to manage the risk. We can talk about that in a later video, but for now let's just go ahead and see how to open that trade and how it's different from that process we just went through a minute ago. And it really is not that different. So we're going to enter that ticker. It's the same page. We're at that options trading page. Enter the ticker. Same strategy, calls and puts. The main difference here is the action. Now we're choosing sell to open. And now it should become clear as to why you don't want to sell to open when you're trying to take profit on an option you hold. Because this will open a new trade. You have nothing in your account right now, and you choose sell to open. Now you're going to have a negative option. It's going to say -1 put or whatever. You're going to essentially be owed a put. Okay, so put in your quantity, put in your expiration, put in your strike, put in whether it's a call or put. Calls require more margin because there's unlimited potential loss. If the stock goes up and you're selling a call, you're naked a call, which means that you've just sold this call option, you're not holding the stock or anything like that, and the stock goes all the way up, you're going to be bankrupt. For a put, there's limited risk based on how far the stock can fall, and I'm going to leave that up to you to figure out how much risk you're willing to take. But in general, the way to calculate the margin for a call or a put that's naked is look at the price of the stock and see how much it can fall potentially and how much you could lose potentially, and divide that by 2. That's how much margin you'll usually have to put up. So here we see an order that's set here with a small bid to ask window. In this case, you might just want to go with market. I mean, I wouldn't care too much about those 1 or 2 pennies. So here I'd go with market in this circumstance. Now, trade type's going to be margin because you're getting cash right away for selling this call or put, but you haven't completed the trade yet, so you're essentially on the hook. And that's it. I mean, it's basically the same circumstance as entering a sell to close order. The only difference is you're choosing sell to open. Just remember, this is the big point of this video. Sell to open means you're opening a new trade. Sell to close means you're closing an old trade. That's pretty much it. So if you have any questions about this, let me know in the comments section below. For now, we're going to move on to the next point, finding a break-even price. This kind of goes back to buying a call option. Let's say you're buying a call option and you want to know whether that call option is going to be profitable over a certain period of time. It's not an easy calculation to do. It requires some stochastic differentiation, which is beyond the means of most people. And there are some rules of thumb, though, that you can use. So here's just a quick check for you guys to see whether the call option you're buying is going to be able to make profit based on your theory of the stock. So we're going to go and just alright, so I'll just show you a little tip, a little secret about NASDAQ.com. Not a secret, but a hard to find place. NASDAQ.com. So go to NASDAQ.com, go to market activity, go to stocks. Once you're there, put in whatever stock you're looking at, Microsoft. Alright, on the left side here, scroll down to where it says option chain. And then again, scroll down to where it says see also option chain Greeks. It's really hard to find in the little corner of this website. You've got these option chain Greeks, and you can select your expiration date or whatever. And here are your options. So let's say you're looking to buy a call at, how much is Microsoft? 300. Let's say you're looking to buy a 300 call. All right. So here's one thing that is a good thing to check. Let's say you have a analysis or theory that Microsoft's going to move up like $1 a day. Now you buy a $300 call. Is that going to be profitable tomorrow if it does move up $1 a day? Well, the intrinsic value is going to go up because now you're in the money if Microsoft goes up, but you're also going to lose money because of the time decay of that option. And you can see that here in theta. So for the option you're looking at, 300 call, scroll down to the theta value for that, and it says minus 0.23149. That is how much money you can expect the call option to lose per day, all things being equal. In other words, your theory of Microsoft moving up $1 will be profitable because you're going to be making $1 on the option, but you're also going to be losing 23 cents. In other words, just looking at this theta will tell you how much you need that stock to move to be profitable. That's your break even. So I hope I'm answering that question about break even properly. If this is what you meant, soggy cranberries, let me know. In any case, if you check this theta value, it tells you that you need the stock to move up this much every day. These are changing per day, by the way, so you got to check this per day. You need the stock to move up 23 cents today, if you buy this option to break even. That is, if the option trades sideways, you lose money. If the option, or if the stock trades sideways, you lose money. If the stock moves up only 20 cents today, you've lost about 3 cents, $3 on that option. Remember, cents is, we're always multiplying by 100 when we deal with options. So this is a $23 loss if Microsoft trades sideways, but it's also like a $77 win if Microsoft goes up $1. You're always losing money on options because of this theta value. I hope that answers your question, Soggy Cranberries. And if you have any more questions, anybody, let me know. And one more thing, if you guys could subscribe, I'd really appreciate it. I'm trying to get my follower count back up to 10K, and it's been a struggle here. So I think that's it. If I miss anything, or if you have a video request, let me know in the comment section below.